Good morning, ladies and gentlemen, and welcome to the show on this Tuesday, the 31st of August, 2021. Thank you for tuning in. Glad to have you guys here. Now, we're going to open up the charts right here and take a look at this. There's a former Fed official who's warning of an urgent threat of another financial crisis. Don Kahn, he's a former Fed official, and he says that it's okay. I'll read a little bit of this. It says here, investors cheered as Federal Reserve Chairman Jerome Powell at Jackson Hole speech on Friday, with markets interpreting it to mean that the central bank would not too quickly to wind down its support of the economy. But not every speaker at the annual gathering gave cause for optimism. Don Kahn, the Fed's former vice chair for financial supervision, used the opportunity instead to warn of an imminent risk to the financial stability of the global financial system and called on regulators and lawmakers to take swift action to address these concerns. Dealing with the risks of the financial stability is urgent, he said during a speech to the Federal Reserve Bank of Kansas and at the annual Jackson Hole Economic Symposium. The current situation is replete with unusually large risks of the unexpected, which, if they come to pass, could result in the financial system amplifying shocks, putting the economy at risk. He pointed to the minutes in the most recent Federal Reserve meeting, which indicated that members of the bank's interest rate setting committee saw that there were notable vulnerabilities in the financial system as asset values have risen historically high and government and private debt have reached near record levels relative to the size of the economy. So basically what he's saying is because we're at such historical high debt ratios and because they've already basically pumped up the economy with cheap, easy money, what are we going to do if we have some sort of an economic shock come along? What will in other words, here's the thing. The Fed's got unlimited ammo. Unlimited. They can print unlimited amounts of fiat currency. But there's a cause and effect here. If the Fed does print unlimited amounts of fiat currency, they're going to push us over the edge very quickly into hyperinflation, and the dollar's going to become worthless at this point. And what he's basically saying here is if we get some sort of a black swan event, something that tips us toward deflation suddenly, then where's the ability to print? If they print, they're going to push us right into an almost instantaneous hyperinflation. Right now, we're stumbling toward hyperinflation, but albeit slowly. It says, what's more, Kahn said that the government appeared to be in a poor position to respond to an economic downturn that could result from a bursting of the asset bubble or debt crisis, given that the Federal Reserve has already engaged in aggressive monetary stimulus while the federal government is maintaining historically high budget deficit. The whole thing's a mess, guys. He's spotting this. This Kahn is spotting the same things that I'm talking to you guys about. He's warning of an urgent threat and another financial crisis. They've reached a point now where they can't let anything fall because of the over-leverage. It's just so over-leveraged. Because it would fall to nothing. Everything would basically collapse. And on the other side of that, if they try to restore a balance by adding more money to the system, they're going to hyperinflate the currency. At the same time, what we've got through the population, through every investor, through every person out there, they're starting to notice prices going up, and they're starting to get nervous about the purchasing power of their dollar. It's an awareness that's starting to spread through the world, and it's already reflecting itself in the acquisition of gold and silver. They're trying to. A lot of people are trying to hedge against this, and they're going into gold and silver, and it's putting pressure, especially on the silver market, to perform. Now, I got thinking about this last night. I said to myself, hey, how are they keeping up with the silver demand? You know? Well, there are stockpiles and inventories, large inventories of silver out there that could help them to keep up with inventory demand. In other words, retail demand of silver and or industrial demand. And they were starting to run out months and months ago, and all of a sudden, they seemed like they got into some more silver. Well, I know we all know that for years it went on with the silver market that they were manipulating, and the government was basically turning a blind eye to the silver riggers. For years there that went on, and it's almost like a compliance that is there and it isn't there. It's like an unspoken about thing, sort of thing. Well, I got thinking to myself last night, and they do an awful lot of stuff behind the table that we don't know about to basically what we would call, in parentheses, save the system. I got thinking about this last night, and I said, could the Fed, just basically print up a whole bunch of new money? They can print as much as they want on the printer, and buy silver from some of these people that have been holding it, basically, and then resell it back into the market. Or maybe they're doing something like that. I don't know. Something's going on. How are they keeping up? They've got some sort of a big pile of silver that they're getting into that we don't know about to keep up with demand. Well, even big piles of silver, say J.P. Morgan is supplying the market, with his stockpile. I'm just putting it out there. I don't know if this is actually happening or not. I mean, I'm just speculating right now. But say the Fed and him's doing some sort of a deal. Maybe they're paying him $100 an ounce or $500 an ounce or whatever. They can print as much money as they want, and then satisfying that and using that. I mean, we don't know what they're doing behind the scenes to keep up. We do know if they run out of silver, what will happen. The silver price would skyrocket. Then the gold price would skyrocket. And this whole system that they're trying to hold together would start to hyperinflate the system prematurely, How are they going to hold all this together? It's crumbling all around the seams. It's like a dam, that's ready to break, the system right now at this point. And we're still not over this virus. It keeps coming with more and more mutations all the time, just, wow. Anyway, let's move on and take a look at the silver market today. 23.92. Just thinking about things. I've never seen a time in history where there's more dangers out there coming at us from more different angles. And I've never seen a time in history when the people have been more oblivious to these dangers. The general population I'm talking about, the masses out there, I mean, my channel, a lot of the people watching my channel, and they watch a number of other channels that are similar. And they're aware. But, the masses of the people out there are not aware of any of this. They don't know. And when things start to break apart, seriously, then they'll become aware and they'll say, where did this come from? So the silver price today is down 8 cents. There's extreme volatility in the silver market today. Let's take a look now at gold. You see the price swings and volatility in gold and silver today. Look at the green lines today, and look at it. It's just swinging up and down like a yo-yo. 1808. 1808 it's down $2 on gold today. Giving this little sale on for you guys. Now here's cryptos. 2102 today. And we're looking at Bitcoin at 47,370. We're noticing a lot of strength in the altcoins right now, which means we're mid-rally. Dow Jones Industrial Complex is basically, it's only 1.36 is almost nothing. 35,398. So there's almost no movement in the Dow right now. It was down earlier today, but it seems to made back those losses. That's been the way lately, you know, if there's any dip, people always buy the dip. Let's take a look now at crude oil, 68.64. It's down 57 cents on the day. And the move index today is at 60.14. It's down a little bit, but it's hovering around that 60 mark today. This is your volatility of the credit markets. It's a volatility estimate. Merrill Lynch's option volatility estimate. So this is an estimated of what the volatility is. But it's been staying around 60 lately. Let's take a look at bonds and rates today, and we're looking at climbing yields. We're looking at the 10-year moving up 1.6 basis points to 130. And we're looking at the US 30-year at 1.91 today. And now let's take a look at the U.S. dollar index, 92.48. It's off just a tad. It's going down today a little bit, but it's slowly going down today. 92.48. I'm going to tell you guys, if they keep, I did this illustration yesterday about how about a police station and how deflation is like a criminal that's going to break in the door. It's going to be a sudden sort of thing. It could come if deflation comes. There's about a 6-month window of opportunity between now and next March for it to happen. The deflation will come along suddenly. Anything could trigger it. Wouldn't take a whole lot, you know, just maybe a little bit of a worsening condition in the virus could trigger it. Any number of business failures or bank failures could trigger it. There's any number of things that could trigger it. And once it gets started, you know, it could sweep through the markets rather quickly because it's primed for it. Liquidity's been drained from the system now somewhat to a certain degree, and these asset bubbles have been propped up underneath all that liquidity. Have you ever seen ice in the wintertime? In a puddle? Well, you know, the puddle's full of water, okay? And it freezes at night. It gets real cold, you know? And the next day, water drains out from underneath the ice that's formed because the puddle is draining down into the ground, you know? And it leaves air gaps under there. When we were kids, we used to like to jump on those and crack them, you know, the air gaps underneath the ice puddles. But that's what the system's like. A whole flood of liquidity came in, drove the markets up, and the markets are like that ice that's frozen up in the air, you know, it's way up there. And the liquidity's drained out from underneath it. So now it could fall. And it wouldn't take much to burst these bubbles. So now what if the bubbles burst and everything starts to collapse? The Fed's going to rush right in there and arrest it. But at what cost? The cost is going to be at the expense of the dollar. And when people start to panic out of the dollar, there's no getting them to come back in anymore. And the way I see it, it's going to be a mad rush, a mad panic. I don't know where they've been getting the silver to supply the silver industry over the last few months since the Wall Street gang came in there and and took out most of the physical supply. It seems like they've resupplied, restocked. Where did that come from? I'm thinking to myself, hey, there's silver sitting on the sidelines, but those guys aren't going to sell. So they've been able to resupply the silver and keep it going till now. But if we get some sort of an economic shock and a downturn, and the Fed comes in and restores the balance by creating more liquidity into the system, there's going to be a panic run into gold and silver and cryptos. Mostly gold and silver initially. And they're going to want physical. And so I don't care where they're getting it from. They're not going to be able to get enough if everybody wants it. It's going to run out at a certain point, And then we're going to see these astronomical price gains. Because once they run out of a commodity, actually run out, there's no 1,000-ounce bars anymore. No 1,000-ounce bars to go to the mints anymore. No 1,000-ounce bars to go to industry anymore. And where are they going to get it? They're going to have to wait while the mines mine it out of the ground to give it to them. Of course, that'll put an extra demand on mining, and the price shoots to the moon. Of course, the mines are going to have the money they need for exploration. They're going to have the money they need to get in there and buy new equipment and start getting it out of the ground. But that all takes time. That all takes like 6 months to a year before the miners ramp up production. It takes about a year, actually, at least. The miners can ramp up production, but there's a time lag, a huge time lag there. So during that time, the price could be, when they're out, and they're waiting on new supply to come in, could be massive if they don't let the spot price go up. I'm just thinking off the top of my head here. If they don't let the spot price go up during that time, then what would happen is and they're out of silver and the physical supply. You want to talk about premiums and dealers wanting the stuff. They would even be able to share. I know that they would, over the spot price, over and above the spot price. The dealers, if they get constrained enough, because it's their business, to sell silver and they need supply to sell, they would probably share part of that premium with people who'd sell back into the market. Anybody who's willing to sell back into the market would get part of that premium, or probably a good chunk of that premium, And the premium might go up 4 times, 5 times from where it is right now, if we run out of silver, So we might be talking about them actually holding the price down on the spot market, the spot price down, maybe keeping it only at like $30, and they're out of silver. I'm talking theoretically here, so you're totally out of silver for the market. And them keeping the spot price below $30, maybe $28.50 or something like that. And there being a $100 premium or $200 premium. It's ridiculous. Thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.